Picture this. You have handed in your keys, you have walked out of that building for the last time, and now the question becomes what exactly happens to all the money? Your pension, your 403b, your savings, your health care. What do you do with all of it and in what order? That transition is what we are covering today. Everything that you need to know about how money moves when a teacher retires. My name is May Acosta, and retirement transitions for educators is one of my favorite conversations to have because once you understand how all the pieces connect, the stress of retirement mostly disappears. What feels overwhelming becomes a checklist, and a checklist is manageable. So let's walk through it together. Your pension does not start automatically. You have to apply for it, and that timeline matters. Most state pension systems require you to submit your retirement application 60 to 90 days before your intended retirement date. Some systems take even longer to process. If you miss that window, your first check can be delayed by months. When you apply, you will also be asked to choose a payment option. Most pensions offer several, including a higher single life benefit that stops when you pass, or a lower joint and survivor benefit that continues paying your spouse even after you pass away. This is one of the most important financial decisions of your retirement, and it is irrevocable once you make it. Do not rush this. Call your pension system, request a benefit estimate, and get that paperwork in early. Give yourself a runway. When you leave your district, your 403b stays in your name, but you have decisions to make about what happens to it. Option 1, leave it where it is. Your money keeps growing, but you can no longer contribute, and you are still subject to whatever fees the plan carries. For some plans with good low-cost options, this is fine. For high-fee plans, leaving it there means the fees keep draining your account even after you leave. Option 2, roll it into an IRA. This gives you access to a much wider universe of investment options, typically including lower cost index funds. A rollover does not trigger taxes as long as you move the money directly from one account to another, never taking it as a check in your name. The tax implications of doing this wrong can be significant, so please work with a professional. Option 3, convert it to income. Depending on your plan, you may be able to set up systematic withdrawals or convert a portion to a guaranteed income stream. We talk about this more in the income sequencing section. This is the one that catches the most teachers off guard: Medicare. It does not begin until age 65. If you retire at 58 or 60, you have a gap. Here are your options for that bridge period. First, your district may offer retiree health coverage. Ask your HR specifically about this before you retire. Some districts offer it as a subsidized rate, others at full cost, and some do not offer it at all. Second, COBRA. When you leave your job, you can continue your current employer coverage for up to 18 months through COBRA. The catch is you pay the full premium, which can be $600, maybe even up to $1,400 a month, depending on your plan and your family situation. Third, marketplace coverage through healthcare.gov. Depending on your income in retirement, you may qualify for subsidies that make marketplace coverage more affordable than COBRA. This is worth calculating before you assume COBRA is your only option. The healthcare bridge is one of the most expensive and underplanned parts of early teacher retirement. Build it into your numbers before you hand in those keys. Once you are retired, you do not just pull from accounts randomly. The order in which you draw down your accounts has a real impact on your taxes and how long your money lasts. Here is a general framework for teachers. In early retirement, especially if you retire before 59 and a half, your 457B is often your first draw since there is no early withdrawal penalty. Your pension income may also be coming in, so the 457 fills gaps without triggering penalties. Once you reach 59 and a half, your 403B or IRA becomes accessible without penalty. At that point, you begin layering in those withdrawals strategically, taking enough to stay in a lower tax bracket, but not so much that you spike into a higher one. Social Security. If you are eligible, it is generally best delayed as long as possible if you can afford to wait. Every year you delay past 62 increases that monthly benefit. Waiting from 62 to 70 can increase your benefit by as much as 76%. The goal in retirement is to recreate a paycheck, a reliable, predictable monthly income that you can count on. For most teachers, that paycheck is built from three streams: your pension, which is your foundation, withdrawals from your 403b, 457, or IRA, which fill the gap and fund your lifestyle. And eventually, Social Security, which adds a third layer of income that you cannot outlive. When these three streams are coordinated well, drawing from the right account at the right time in the right amount, retirement stops feeling fragile and starts feeling like freedom. The retirement transition does not have to be overwhelming. It just needs a plan. And the earlier that you can start building that plan, the more options that you will have. If you are within 5 years of retirement and you want to walk through your specific transition together, pension activation, 403b decisions, healthcare, income sequencing, that is exactly what our complimentary review is for. No pressure, no sales pitch, just your numbers and a clear picture. If you would like more information about that, check out my link in the description. Thank you for watching, and share this with a teacher who is getting close to that finish line. They will thank you for it.